Okay, good morning, students. Shall we start the session, guys?
Good morning, sir.
Good morning. Shall we start the session? The others would be joining in the meantime. So today we are going to discuss, we are supposed to finish this case and then we'll start the new chapter, risk and return, that you may have studied in your financial management course earlier. So we'll finish this case. I hope you have attempted to solve this on your own, as I told you, as I requested you to do this, so that you know what is happening in this question. And then I have also identified one case for equity valuation, but I don't know when would I get the case from the library. So I may discuss that case maybe in the extra session or whenever we get a chance, but I will discuss that question for equity valuation for sure, right? Okay, so let us start the session, right? Shall we start the session, guys? Please say something. I want some participation, please.
Yes, sir.
Yes. So, guys, as you remember the case is of Reagan engines, where two siblings own the company, and each one of them has 1,50,000 shares. So total 3 lakh shares are there. The EPS of the company at this moment is 5.35. The dividend that they have distributed in the last year or current period is 3,20,000. That is 6,40,000 in total. Company's ROE, that is return on equity, right? Return on equity is 21%, and the cost of equity, or you can say the required return that they have to earn a minimum, right? So if the company makes more than that, company is doing a good job. 18%. You are also given some industry information about EPS of 3-4 companies, DPS, that is dividend per share, the stock price of these 3 companies and the average, and the return on equity also for these 3 companies. With this R stands for cost of capital or the required rate of return, right? 15%, right? There is one more information given in one of the paragraphs, I think the second or third paragraph, that the Nautilus Marine's engine has a negative EPS, but that is because of the return off in the last year. They were abnormal, right? So if we get rid of that, because see, abnormal events does not happen every year. So if we get rid of those items from the income statement, the EPS is around 2.07. So that means the average of the industry would change to 1.47. So that is 1.09 plus 1.26 plus 2.07, all of them divided by 3, right? That is the average. So the industry average has been modified because the Nautilus Marine engines EPS is 2.07 without the write-off. That is what I'm saying. I have also put down the values and I have computed the dividend per share. So if the dividend is 6,40,000 and the number of shares are 3 lakh, then the dividend per share is 2.133 that we had discussed. Now, some of you were asking me, like, they were not able to follow this, right? If company's EPS is 5.35 and company is distributing 2.133 as dividend, right? So that comes to 39.88 in terms of percentage. So 39.88 is the payout ratio, and remaining must be the retention ratio. So out of 5.35, 60.12% is kept in the business. That is important information that we know why it is important, right? And we are supposed to value the equity. We are supposed to calculate the share price. So the first question, let us just look at the first question. The first question is very straightforward. Using the company's current growth rate, what is the value of the stock? So to value the stock today using company's growth rate, we first require the company's growth rate, right? We need to calculate the growth rate, the rate at which the company's cash flows are growing or the dividend is growing, right? So the formula is retention ratio into ROE. So retention ratio is 6.12% into 21% is the return on equity that we know from the input information given to us. So growth rate also we had discussed last time, 12.63, and we know the dividend today. And if we know the dividend today, applying the growth rate, we can calculate the dividend after 1 year. And then we had put down the values in the formula. So if it is perpetual growing perpetuity formula, the formula is dividend after 1 year divided by cost of equity minus G. So that comes to 44.71. I think this is what we had discussed last time. And now you must have practiced. So I believe you know this, right? Guys, fine, guys? Hello? Devlina, Ayushi Pandya, Ankita Majumdar, can you?
Can you please explain how we got the dividend of the first year, that formula?
Sorry, beta?
Please, please explain the how we got the dividend of the first year while growing purpose.
Yes, so you know the growth rate beta 12.63 percentage, right? You know
Yes,
the
sir.
growth rate 12.63 percentage. So that
Yes, sir.
means the dividend after 1 year would grow at 12.63 percentage, right? So how do I calculate the dividend after 1 year? Dividend zero, that is dividend today, into 1 plus G. So because the growth rate is 12.63 percentage, 1 plus growth rate is 1.1263. You can see the computation here, beta. So 2.13333 into 1.1263, that is the growth rate applied, 1 plus G. The dividend after 1 year is 2.40. Right, Deolina? Right, beta?
Yes, sir. Thank you.
Yes. So let us look at the second question. I think we were stuck at the second question. Uh, uh, so let us look at the second question. The second question suggests that company has an advantage in terms of technology it has. But remember, company cannot have technology advantage forever. Even when iPhone had come, Apple had designed the patented touchscreen technology. I mean, this was one of those few mobile phones with a touchscreen which is very sensitive, right? With retina display, this and that. Uh, Apple cannot believe that this advantage they would have forever, right? So similarly, this company has an advantage, a competitive advantage with this technology, but a similar identical technology can always be patented, right? So company believes that company's growth, that is 12.63 percentage, which is a very good growth rate in dollars. Remember, these are in dollars, right? Which is a very good growth rate. Would not be there for very long, would not be there for more than 5 years, right? And after the 5 years, company would be into transition period. That means company would not earn more than the industry is making, right? So there are two growth stages, right? There are two stages of growth. In the first 5 years, the growth rate is company's growth rate, and after 5 years, company believe that the growth rate cannot be 12.63 percentage. Growth rate would be the industry's growth rate, right? Which we will calculate in a moment. So that is the information. So now the question is, what is the stock price if we go with this intuition? If we go with this assumption that after the 5 years, company would not have the advantage, right? So what is going to be the stock price today, applying the present value formula, right? So can someone help me solve this, please? How do I go about this? Very straightforward. May I ask Ayushi Pandya, please? How do I solve this, beta? Ayushi Pandya ji, please. Ayushi, can you start your this thing? Unmute yourself, beta.
Sir, just a moment.
Huh. The question is that the growth rate is different in first 5 years, that is 12.63 percentage, and the growth rate is different after 5 years. And you are supposed to value the stock price. You are supposed to calculate the stock value, right? Yes. How do we go about it, beta?
Or as in, still
So,
can
as in, so we will calculate the present value. That is what you are saying?
that is how we will begin, right?
Huh. I have given you, let's say, the dividend value today, right? So if I apply the growth, so see guys, in the first 5 years, you can see that I have used different colors so that one could follow. In the first 5 years, the growth rate is going to be 12.63 percentage, right? Because that is what company believes, right? Company believes that it has technological advantage in the first 5 years. But after the fifth year is done, from the sixth year onwards, sixth period onwards, the company's growth rate would be industry's growth rate. So that means we require the industry's growth rate. We know our growth rate, but we do not know the industry's growth rate. So how do I calculate industry's growth rate? Applying the same formula, right? We can calculate the industry payout ratio, just like we calculated for ourselves from the industry data that is given to us, right? So if we know the average of industry average of EPS, and if you know the average of DPS, we can easily calculate the industry retention ratio. So I will just out of 1.47, if let's say 0.44 average is distributed as dividend, the remaining must be the retention by the industry, right? So using this, I can calculate the retention ratio, and I can also calculate the industry payout ratio, industry retention ratio, and industry payout ratio. And then we
So
know
all
how to.
this,
Yes, please, beta. Yes.
so all these APS and retention ratio is given in the question, right?
Huh, everything, all this is given. This table itself is given. This table is given.
Okay, sir.
This question, please read the question, beta, before. That is why I had told you to read come prepared, beta. Otherwise, I mean, the question has a lot of information to process in the first place. So then you would not be able to follow, right? So please read the case. The industry EPS is 1.4733. If I know the dividend, average dividend, I can calculate the payout ratio, and the remaining must be the retention ratio, right? So I can calculate the growth rate using the retention ratio into ROE formula. So I know the ROE of the industry. I will go back to the information given to us. See, ROE of the industry is 0.11, and the retention ratio we just calculated is 70.36. So 70.36 is the retention ratio into 11 percentage. That comes to 7.74 percentage growth rate. So now the information is kind of clear to us that in the first 5 years, the growth rate is 12.63. In the after the fifth year is done, that is from the sixth year, the growth rate is 7.74 percentage for infinite time, because there is no life is given of the company, so company will have growing perpetuity after from the sixth year onwards, right? So now the information is there with us that 7.74 would be there forever, I think, from this time onwards, and we will have 12.63 from uh, period 1 to period 5, right? So the same information, guys. We know the dividend today 2.13. We know the growth rate for the company for the first 5 years. So that means we can multiply this with 12.63. You can see the formula. You can see the formula, right? You can see the formula that uh, uh, 2.13 is the dividend today is multiplied with the growth rate 12.63 for the first 5 years, and then you keep on doing that for the 5 years. You can also do this manually. You can use Excel also. So this will help you calculate the dividend at the end of each of these years till 5 years. And after the fifth year, guys, for the sixth year, you will apply 7.74 percentage. So the dividend for the sixth period is 4.17. Applying 7.7, that is 1 plus G, that is 1 plus 7.74 percentage, applying 4.17. So now you know the dividend for two different stages, first 5 years and from sixth onwards, right? So how do I know the value today? So it's a combination of two things. I will calculate the present value of these five dividends that the company is paying value today, and I will also calculate the present value of growing perpetuity, that is 4.17 dividend at time 5. So this is also, you can call it terminal value, right? So I'll just use the diagram. After the fifth year is done, from sixth year onwards, the dividends are constantly growing at 7.74 percentage. So I will apply the uh, growing perpetuity formula, at time 5. So dividend 6 would be used, 4.17. So the value I get is 57.37. So all the future dividends from sixth year onwards, the value at time 5 is 57.37. I have already calculated the present value for these five numbers, that is 10.02, right? So if I do this, uh, uh, right, uh, this 28.52 is the present value today, plus 10 rupees. The summation of this is 38.55, because 57.37 is at the end of fifth year. So what is the value today? 28.522 plus 10 rupees 38.55. Please ask me question, guys, if you have any, because this was the only challenging part in this question. Yes, I mean, in terms of calculation. Otherwise, see, questions are not difficult. In fact, what we have done so far, the information is given in a different way. And in reality, also, the information is scattered all the time, right? You have to gather the information. That is the only difference. Otherwise, the question is not at all a new question. Yes. Right, guys? Please ask me questions. Hello?
10.02 जो है वो मैन्युअली है, यानी मतलब हर 2.4 को डिस्काउंट किया देन 2.7 को डिस्काउंट किया, ऐसे है या फिर वो प्रेजेंट
ऐसे भी
वैल्यू
कर सकते हो, and because you know the growth rate beta, you can also use the growing annuity formula for 5 years.
ओके ओके
So you can do this, man. So in Excel, see, everything becomes so easier. So I have used the NPV formula. So I can use whatever I want based on my convenience, right? But if you want to do this manually for each one of them in Excel, that is also possible. Or you can also use the growing annuity formula to calculate this. That is also possible because you know the period. You can do that, right? You can do that.
एक्सेल में ग्रोथ एन्युटी वाला पॉसिबिलिटी नहीं है ना, मतलब फॉर्मूला
नहीं, वो नहीं है, वो नहीं है, वो नहीं है, एक्सेल में नहीं है, एक्सेल में नहीं हो सकता है. यस, एक्सेल में हो सकता है, बट यू विल टाइप द सेम फॉर्मूला दैट यू टाइप इन द नोटबुक. दैट्स इट. So then
Yes.
it becomes challenging because you know if you mess up with the what I say, if you mess up with the commas or something, brackets or something, you will not have the right answer. That's the challenge, right? So it's
Yes.
okay. You can also do this manually. That is absolutely fine, right? So 2.40 discount by let's say what is the cost of this thing? We were supposed to discount this at what rate? Let us look at the discount rate. Discount rate is going to be what? Cost of equity is D25. I just forgot the number. D25 is 18% is for Reagan engine. So I'm discounting this 2.40, 2.71, 3.05, 3.43, 3.87 at this 18%. So you can also do this manually. So 2.40 divided by 1.18 power of 1. And then you just drag, because if you select this as n, you can just drag and get the answer for each of them, right? So this 10.02, as you mentioned, beta, is the present value of this 5 cash flows, and 57.37 is the present value at time 5, at the end of 5th year, for all the future cash flows, dividend growing at 7.74% using growing perpetuity formula. But that is at time 5. What is the value today? The value today is 28.5229. So I will just use the simple present value formula to arrive here. And the summation of both, the sum of this cash flows as well as the future cash flows after 5th year, is the share price today, should be the share price today using industry average, right? Okay. First and second question was a bit challenging. If you have understood the first and second question, the third and fourth question, third, fourth, five, six questions are very straightforward, right? The third question, let us see. What is the industry average price earning ratio? What is Reagan's price earning ratio? And comment on any differences and explain why they may exist, right? So industry average price earning ratio and Reagan's price earning ratio. Do I need to teach you guys? I mean, it is just a simple formula, price by earning ratio, right? So you know the market price of the industry. I will just go there, right? You know the price and you know the average earning also, right? Average earning is also 1.4. Just a second, huh? Why I have taken 1.5067? That I should change, because that there are two textbooks with two different numbers. So in one of the textbook they have messed up with this thing. They have messed up with this number. They had 1.19. So I have solution as per both, in fact, 1.19 and 1.09. So while copying the entire sheet, I may not have edited this part, but it is the same, right? Average EPS is 1.47 and average stock price is this 18.08. So 18.08 divided by 1.47 is industry's price earning ratio, right? Similarly, you can also do this for Reagan company. But remember, for Reagan company, there are two share prices, one as per question 1 and second as per question 2. So you can do for both. So in the first question, the price was 44.71. We can calculate for 44.71, and the earnings are 5.3 per share. So I have just put down the values, right? That's all I have done. Not at all a challenging thing. Question 4 is a bit, a bit different question. Let us discuss that for a few minutes. Okay, the question is also saying that why there is a difference between Reagan's and the industries Because see, the thing is that the market price earning ratio for the industry is 12.26, and the price earning ratio for Reagan is 8.36 and 7.21. Can someone tell me why? Can someone tell me why? Why the industry price earning ratio and the price earning ratio of the company are sounds or look different, please? Why it is more sensitive in case of industry, please? Hello.
Because of price, that is Reagan's price of share is higher, and market price is lower.
Right, because see, one of the first reason is that it is the average of all, right? Average of all. So some companies may be doing great, some companies may not be doing so great, right? Second is that there may be a lot of speculation, because if the companies are doing good in 1 year and not so good in the second year, that would have implications on the company's stock, because when there is a lot of fluctuation, there is a lot of noise, there is a lot of demand and all that, right? So that could also cause. So market price is the reason, market price fluctuation is the reason. In case of Reagan, understand, Reagan's growth rate is very much constant, and when the company's performance is more or less constant, you see less speculation in the market. So that's why the price may not, the value that, not the stock price, I should say, the value that we have captured may not be visible there, right? Okay.
Sir,
Yes, please ask me. Yes.
sir, in the industry's price earning ratio, the earning per share is, can you go up?
I will just go up. Let me just recheck my answer. It is at per 1.47 or 1.51. Let me just see. Okay, I should put this value here. Just a second, na beta. It is merged, that's why. Fine. 12.299. Huh. Yes, now tell me. Yes.
Sir, can you just go up? Sir, the industry average for EPS is isn't it 0.69 for
Points.
EPS?
But can you read the second paragraph? I have the textbook with me. I hope you have the same textbook, 11th edition by Ross Westerfield, Jeff, Jordan, and Kakani. So there are multiple variants of this book. So I hope we have the same question. Chapter number 9. Yeah. If you see the question, the second the paragraph right after the table is given, if you see, without the write-off, the EPS for the company would be 2.07. That is for Nautilus Marine engines, right? So see, this is negative, beta. This is negative, and they have also given that why this is negative. This is negative because company has written off lot of abnormal items in the last year. That is what they suggest, right? So if you get rid of those abnormal items, that does not happen every year. Company's EPS should be 2.07. So I have recalculated the industry average based on the information given to us, that Nautilus EPS is 2.07 without the write-offs, right? So it is an abnormal item causing the EPS to go down. That's why we have adjusted the EPS. So EPS is recalculated. You can say that EPS is recalculated given the question itself. Yes, right, beta forum.
Oh, sir, how it is recalculated? Can you just show?
That is given to us. That is given to us already. Recalculated by the company itself, or the information given the question itself, that without the write-off, EPS for the company would have been 2.07. So that is key calculated. That is getting rid of all those abnormal items. Let me give an example, beta. Let's say companies on an average performance is 10%, or company makes 10 rupees per share. Let's say EPS is 10 rupees per share. Now this year there was a fire in the company, and because of that, company has incurred loss. But when I'm evaluating my company, right, my company that is not right, my company that is taking industry data, and where one of the company had a fire, and because of that the EPS was lower, should I consider that negative EPS to evaluate my company? Tell me, because fire does not happen every year, right? So because I'm valuing my company based on industry data, I should get rid of all those abnormal things which may not happen every year in my business as well as in the industry. So it is recalculated for decision making, right? So that is why 2.07 is taken, beta. Right, beta?
Yes, sir.
Yes. So that is also something you do in accounting when you calculate ratios and other things, right? To judge a company, especially judging the external and competitive goodwill. If you remember, goodwill and all this valuation right? We get rid of all those abnormal items to value goodwill because abnormal things don't happen every year, right? So we cannot judge the company based on abnormal items. That's why we remove the effect. Let us look at the fourth question. I don't want to take too much time on this 4, 5, 6 question. Fourth question is on this side. Yeah. Yes. The question suggests that company's growth rate declines to industry average after 5 years. What percentage of the stock value is attributed to the growth opportunities and what is not? Yes. In a way, that is also they are asking. How do we solve this, guys, please? समझो कि कंपनी का growth rate declines to industry average after 5 years. What percentage of stock value is attributed to the growth opportunities? What?
Sir, in this we can solve it by, like, in the first case we can just use the dividend 1 upon the rate, and in the second case the formula we can use is dividend 1 upon rate minus the growth required rate minus the growth rate, and then
Wonderful.
the two answers will find the difference, so we can find the effect of the growth rate.
Wonderful, wonderful. Great, great, beta. See, so because see, in one case you are expecting that there is no growth, understand? And in the second case, you are applying the fact that the growth is there, the growth exists, right? And we have already calculated the numbers. We just have to put the values, right? So if I assume that, please listen to this very carefully. The earnings right now is 5.35%, and the capitalization ratio, or you can say the cost of equity, the cost of capital is 15%. So if I am discounting this with 15% or capitalizing this with 15% into 3 lakh shares, the value of the company should be 1,07,000. So what I'm assuming, that the company's earnings are not growing at any rate. It is constant forever, right? So that's why I'm capitalizing this at 15% today. So the value works out to be 1 crore 7 lakh something. Yes, right? Then the second option we have is that let us look at the growth potential. And because the question suggests that that the growth would not be there after 5 years, they are talking about the second case. So as per the second case, the stock price is 38.55 and the number of shares we have is 3 lakhs. So the value is 1 crore 15 lakhs something. So guys, without taking growth into account, applying that on earnings or dividend or whatever you say, as Dhruv was saying, you can also work with dividend and calculate this. That is also absolutely fine, right? Right? You see the change, right? You see the change that without growth, if you do not apply any growth, the value of shares or today is 1 crore 7 lakh, and with the growth, it is 1 crore 15 lakh 64,100. So that means without growth, out of 1 crore 15 lakh, 1 lakh 7,000 you anyways make without any growth. But if you have growth, so the remaining is because of growth. So I can say out of 100%, 92.53% is because of without growth, and 7.47 is attributable towards growth, attributable because of the growth opportunities that the company has at different rates, right? For the second case. So that is what it says, that without growth 1 crore 7 lakh is anyways there, and with growth it is 1 crore 15 lakh 64,100 is there, right? So you can also use this using the dividend. That is also absolutely fine. You can some variation would be there, but that should not matter because the percentage of retention and everything stays constant, so should not really matter. The fifth question, let us see. Fifth question, where is the fifth question? Assume the company's growth rate slows to the industry average in 5 years. What is the return on equity? Mayur, how do I solve this, beta? Mayur, Ankita, Anjali, or anyone, please. At least those who are participating constantly, regularly, because if they have good connection, please.
Sir, return on equity is growth rate divided by retention ratio.
That is yes.
So we have the retention ratio that is calculated above, and also the growth rate of the industry we know. So in that way we can.
So using the G formula, we can back calculate the ROE, right? That is what you are saying. You know the G formula. The G formula is retention ratio into ROE. Now we want to calculate ROE. We know the growth rate. We also know the retention ratio. We can back calculate the return on equity using this formula, right?
Yes,
right, right? So that is what we have done. See, we know the growth rate 7.74%, and we know the retention ratio 60.12%, and using that we can calculate ROE, right? The sixth question is like a subjective. Sir, I can rejoin and I'm having network. That's fine. Yes, please join, beta. But please join, and I will admit you because the participants, this thing is open only. Can allow. I can admit you right that moment only. Yes. The sixth question, guys. So how do I answer this, please? Very fast because we have to go to the next chapter. Yes. Carrington and Genevieve, I don't know how do I read this, are not sure if they should sell the company. If they do not sell the company outright to East Coast Yacht, they would likely to try and increase the value of company stock. In this case, they want to retain the control of the company. They do not want to sell outside. Okay, how do I answer this, beta? How do they maximize the value of the company or stock price? Anyone, please. What creates value? The first class of financial management Maya session. The value is created by the investments company has identified, right? You may conserve value or may increase the value by few bits because of selecting the right debt or equity or right mix of debt and equity. But always remember the value is created if because the debt is constant in this question. So you cannot change the value of the business because of the borrowings, right? Because you want to be constant. So the only way you can maximize the value or maximize the stock price is by selecting the right investment opportunities. Remember that. So that is the answer. The answer is that company can achieve that only by selecting the right investments, right? Right. So that is the answer for the sixth question. If we are done, can we go to the next chapter, guys? Please say, give some response, please.
Sir,
Yes, please ask me. Yes, please ask me. Yes, beta.
sir, I don't have a doubt, but the Excel sheet that you have shared with us,
Mhm.
in the second part of this question, the table, the colorful table, where we
Mhm.
calculate the growth with respect to see. So, sir, in the sheet that which you have shared, there is a question. The question is over this, so we can't access the table, and since we can't edit the sheet,
So
can
sorry,
you
sorry.
please?
Can you repeat? But I just said question is before this. Sorry.
Yeah. Sir, actually, the question is imposing this table in the sheet that which you have shared with us. So we can't see the content of the table in the Excel sheet that we have shared.
With
Could you please?
you can navigate. I think the image. You can navigate the image. I think,
Uh,
beta.
no, sir. It is view only, so we can't edit.
Okay.
I
Okay.
tried
So
doing it. So
let
could
me
you
see.
please do it?
I will do this. So see, why am I sharing the Google Sheets? Because the moment I share the Google Sheets, anyone can access anytime. That's why I'm putting this in
Yes,
Google
sir.
Sheets. But I will see that. I will see that. I will change
Yes,
it. Yes.
we were referring to it side by side. That.
So good, Rucha. I will definitely share the latest one after this class for sure. Yes, beta.
Okay.
Yes.
Okay.
Thank you, beta.
Thank you, sir.
So guys, can we go to the next chapter, beta?
Sir, before we move further, actually, yesterday we had a discussion, and on the base of that, sir, can the quiz be done, taken in a certain later part because it's Saturday is holiday and people are might be not there. And apart from that, sir,
Monday, Tuesday.
Yes, sir. Any day that is not a holiday will work for us. Just not.
Okay, sure. So Monday I'm keeping, right, beta? Please, Monday, don't delay this beyond Monday, beta, because otherwise, see, because you have assignments and everything would be at the same time, and then you will say, sir, आपका course का एक साथ आ रहा है, बेटा. तो प्लीज बेटा मंडे रखिए ना, मंडे मैं करना चाहता हूँ, वरना आपका ही बर्डन बढ़ जाएगा, है ना? थैंक यू सो मच. सो मंडे रखते हैं. See, I do.
सैटरडे की क्लास में आप प्लीज सॉल्व करो ना, यानी जो मतलब अपनी explanation होता है,
Sure.
तो उसमें
We
डाउट्स
will,
वगैरह जो
so we will keep the session. I do not know this week at what time I could because I have to take one session in other course also. But we will have the session on Saturday, and I will also inform you 1 hour before. And it is likely to be in the afternoon. But still, I will inform you tomorrow evening. Tomorrow is also holiday. I think you would not have a lot of sessions, maybe one session or something, not more. I do not know the schedule for tomorrow, but tomorrow you may not have a lot of sessions, or you may not have any session because of Gandhi Jayanti, I guess. But I will inform you tomorrow for Saturday, right? Yes, I understand. And Monday we will keep the quiz. That is absolutely fine. So can we go to the next chapter, guys? Mayur or someone, Ayushi, Devlina, someone please say something.
Yes, sir.
Yes. So guys, can you tell me how much of risk and return you have studied? Because so that accordingly I could teach. Risk and return you have studied, right? The chapter risk and return you have studied. Hello. Someone please participate. How much of you have studied? Dhruv, Anjali,
Sir, can
please.
you show us what are the topics that you are going to cover so
So
we
have you
can?
studied standard deviation, variance, and all that?
I think yes.
So we are doing that in statistics, but from finance perspective, we haven't seen those things.
So you have not at all studied the variance and
So we
standard
have
deviation.
studied the concepts in business statistics.
But no, in finance to calculate the risk.
No, sir, we don't. No, sir, not in finance.
Okay. But I'll be a bit fast because some things would be overlapping with what we have discussed in dividend and debt valuation, that is bond valuation and equity valuation. So whenever you are finding it difficult to grasp, please let me know. So initial few slides would be overlapping, and then we'll be discussing the standard deviation and variance to measure risk, right? Okay, guys.
So is it possible that we can have the PPTs in advance on Moodle for all of the sessions? Because right now there are so many.
So you wanted a Moodle?
Yes, sir, because then we can see which topic and which PPT we have to refer for it.
Okay, fine.
Like right now we have all of these mails, so some time gets wasted in navigating between those
Fine.
materials.
In fact, I told someone also that I would like to upload this on blog, but some student had requested, okay, sir, it is difficult to follow blog. It is easier for us to go to the email and find it. But I will upload them on Moodle for sure. Yes,
Actually, so the PPTs you have probably mailed us in different parts also, right? Sometimes. So that is why there is some confusion in that.
Fine. I will upload the final ones on the blog or somewhere. I will share the link with you for sure. Yes. Let me do that. Yes.
Okay, sir. Thank you, sir.
Yes. So guys, in case if you have studied this, please let me know so that we are not spending time on something which you all of you already know and wasting our time rather. So please let me know that. So we are going towards the cost of capital and cost of equity. So through risk and return, right? So let us understand this. So the first concept is let us understand the concept of risk and return. And before we start understanding the concept of risk, let us understand what is return, right? How do you calculate return? You calculate the return by how much you have invested today and how much you have after 1 year, right? And after 1 year, you may have more money because the share price has changed, or you may have received a dividend, right? So uh, and the percentage of that is basically returns. In America they call that dollar returns. We can also call it absolute returns or total return in terms of value, and then you can calculate the percentage. Yes.
Sir, screen is not visible.
Okay. Just give me a second. Is it visible now, beta?
It's not. Yes, sir. Yes, now visible.
Yes, sir.
Yes. So let's say you are putting 100 rupees today, and after 1 year the stock price is 110, and company has also paid you 10 rupees dividend. So the income, the return you have is $20 because you have invested $100. The percentage is 20%. So that's something we have discussed in equity valuation to arrive at the formula. If you remember the formula of the required return, the formula for calculating the share price. So you know this formula, right? So let us not spend some more time on this. So the rate of return is dividend 1 plus price after 1 year minus price today divided by price today into 100 to get the percentage, right? All of you know this, right? I should not spend so much time on this, right? All of you know this, na? Right? So at least give some feedback, guys. It becomes difficult for me to understand, or start your camera and show you some face movement so that I get a feeling that you are moving. Mayur, can you start your camera, beta? Anjali, Mayur, Ayushi Pandya, please. Everyone, please start your camera, please. Hello.
So it is
Yes.
starting.
Yes, yes. Thank you, beta. So this is easy to understand, right, Anjali? Is it fine, beta? Is it fine? This you know already, Mayur, right? Please show face movement is fine. You don't have to start the
Sir,
audio
yes,
part.
sir.
You can, yes, yes. Okay. So you know this already, right? Please, everyone, tell me if you don't know this, right? So we can also calculate the percentage. So in this case, let's say 4,500 at what we had purchased. We have received the capital gain of 300 plus $27 dividend. So the total gain 327 divided by what we have invested 4,500. The percentage is 7.3%. That you already know. So let us not spend time on this. Can you do this every year for every company? You start with price today, or let's say let us do that for historical information of some company. Let's say HUL company. This information is of HUL, actual information of HUL, right? Can you calculate the percentage return and absolute return both using the dividend as well as the capital gain every year? Can you do that? Right? So what I will do at 1992, for the 1992 calendar year, I will look at the 1991 price, ending price, or beginning price, 1992 beginning price. I will look at the ending price, that is capital gain, and I will also find out the dividend. And there are a lot of websites giving you that data. You can go to Yahoo Finance for Indian companies, right? You can go to Google Finance. You can go to a lot of websites. There are hundreds of sites if you just punch that in the Google, right? So you can calculate the total return for each of these companies for whatever period you want, whatever period you want to research upon, right? You can do that for any company. You can calculate the total return. You can also calculate the percentage return for every company, right? Right. So after doing the returns for every year, let's say I have identified Apple and I have calculated the rate of return for 10 years, let's say last 10 years, right? Can I do the average of 10 years? And what does this imply, Anjali? Please, Ayushi Pandya, Mayur, what does this imply? I'm seeing only few people on the screen. That's why only 3 names. That's why I'm reading their names. So don't feel others don't feel that I'm not reading your names. Please participate, right? What does this average imply? If let's say I have taken 10 years data of Apple, let's say 10 years rate of return of 10 years, and then I'm averaging it. What does it mean? And what does this imply? Please tell me. Anyone, please.
So that we are expecting at least that much percentage of return from Apple.
Yes, Mayur, please go, beta. Yes, Anjali, thank you. Mayur, please.
I think the average mentions gives an idea to the investor who is new to the company. That is, suppose he is trying to get highest and lowest. So apart highest by average, he can have some fair idea about it.
So you know finance now. You always look at the historical information to predict the future, right? That's how we got to know about things. Because see, how do you, let me ask you a very general question. How do you know that you will do great in this year in finance course? You look at your previous marks for the finance courses, right? And that is how you know. No, I got 60% in one exam, 70% in second exam, and so on. So I think on an average, I know enough of accounting or finance. I should make at least 60-65%, and that comes from experience, right? That comes from experience of the past. So you can do this for any company to predict the future, and then you can apply probability. So you have enough knowledge of finance. That from your answer, I could say that, right? So this is the information of Apple, let's say, of last 10 years. Apple has 28.13% return for the last 10 years. And it is 93% higher than Nasdaq Composite. Nasdaq Composite is basically including almost all the companies, and the performance is 14.58% for the last 10 years. It is for Apple. It is 93% higher than Nasdaq index. Also, let us compare this with the other companies in the same industry, right? Apple has 28.13, Amazon has 34.11, Alphabet has 9.74. So Apple has 18% is more than Amazon. 18% is less than Amazon, and 189% is more than Google, right? So you can do this for one company, and you can also do this for multiple companies, just so that you know that how good this company is based on the historical information, right? This is another information just so that you could follow that from 2014 to 2019, this is the capital gain performance. So right, there is a beginning value, there is an ending value. So there is a capital gain, and that capital gain can be calculated in percentage, 37.72%. So does not include dividend. Why am I showing this slide? What has happened between 14 and 15? Can someone remind me? What has happened from 14 and 15? So share price of Apple was 561. Now it is 110. What has happened? Any idea? That is the for that I'm discussing this, showing this image. Who said this, please, beta?
So me, Divesh.
Is it Divesh? Divesh, right? So Apple
Yes.
had done 7 shares for 1 share.
Yes,
So
sir.
for every 1 share, you will get 7 shares. That's why the share price is now diluted among 7 shares. It has divided by 7 shares, if you see, right? Apple and companies do that sometimes, right? There are companies, they never do this. Berkshire Hathaway has never done that. That's why the stock prices, if you see, is in lakhs, right? Because
So
they have never
Tesla.
done a stock split. Yes, yes. Right. So
Yes, sir.
companies
Tesla.
do that, and
Tesla
companies
has
do that
done.
so that Tesla has done. And why do they do that, Divesh beta? Please, if you could tell me.
So because after certain period of time, the price or the weight of the price is so much that they can't even move up. So they break down into smaller, like say in Indian market, Eicher Motor did.
Hmm. So that is
So
one reason, and the second
Sir,
reason is that.
sir,
Yes, tell me, beta.
also when they gauge that the prices are going too high and people are not able to afford the share price, so to increase the affordability to every investor, they do this so that the price reduces.
Right, because now you can attract more investors. See, and see if the and yes, please participate. Yes.
कैन इट बी अनदर रीजन कि मतलब सपोज किसी के पास बहुत ज्यादा स्टेक आ जाए कंपनी का तो वो मतलब ओवर पावर कर जाए इस वजह से वो लोग
No,
डाइल्यूट करते हैं
it does not change. It does not change anything because now you had 1 share, now you have 7 shares, beta. But the value of 7 shares would be same, so it doesn't matter, beta. It is like changing the composition of something, but it does not change the right. So it is like this that you have a pizza without sliced, and then you have 6 pieces of pizza, but it does not change the size of the pizza, more or less. I'm just saying, right? It does not change the right. The advantage is that you can reach more people. The advantage is that you can reach more people can buy, and they may also become the customer. Because see, you can reach more people. When you can reach more people, there is more there is automatic marketing about the company, right? And marketing is something Apple does not spend so much money. We all know that, right? Apple is such an amazing company. I mean, if I could get away from this in terms of thinking, they do not spend a lot of money on talking about their product, what technology they use. They talk about what it has a retina display, right? I mean, they never say what is the pixel size and all that. They never have to do that, right? And now you see all these top companies are moving towards something else, right? That's why IT firms are having a greater value today. All these companies are having a good values today because you see they are moving towards another business plan. They don't want to sell the, I mean, they want to sell the product every year to you, but at the same time, they also want you to buy their subscription. So now the business model is going towards subscription because you buy the MacBook Pro or something, you don't buy that for 5 and 6 years. And because they don't want to sell this to everyone, right? They don't want to reduce the selling price. So they cannot have a lot of customer base. So the next idea is that subscription based model. So you buy Apple TV Plus, you buy this and that services, and you pay $100 or something every year. And company's inflow is always there. So that means company can sustain for very long. This is an amazing idea. Most of the companies are doing that. Amazon is doing that. Amazon Prime, right? Amazon Prime. If you look at Amazon, would be losing money, but having larger customer base is an advantage because there is always a inflow. In fact, I don't even know when they are charging me Amazon Prime. I don't even know when they are charging me. I have put up the reminder, and every time the app gets updated, it is deleted. So I don't even know when they are charging me. In fact, they are supposed to remind me 2 days before that the Prime would be updated. So you see that businesses are moving ahead. They are changing their business plan, right? What is holding period return? Please, can someone tell me? What is holding period return? Now we are moving towards cost of capital and something, so we will go very slow. What is holding
So
period?
holding period return is a total return which you get from the holding the
Yes, sir.
security, means it's include dividend plus capital gain.
Absolutely right, beta. Just let me
Yeah.
see the participants list because someone has moved out, so he might enter again. Okay, so the return for the period I have hold on to this investment. I have held this investment. So if let's say I'm purchasing Apple shares for 5 years, what is my return? What is my average return for this period? So holding period return is basically the return for the period for which I had this investment with me. I had the securities with me. There are two ways to calculate this average return. One is called arithmetic mean, and second is called geometric mean. What is arithmetic mean and what is geometric mean, and when which one is better? I should say that yes. I should not say that this bluntly, but which one is better? I would say, at least for holding period return. Yes.
Sir, if we want to expect what return we'll get in next 1 year, then I think arithmetic mean will be the better option. But if you want to see the long term returns, then geometric mean will be a better option there.
So let me ask you a situation based question, beta. Let's say I want to talk about mutual fund. I want to invest in a mutual fund for certain years, and I should what average I should take?
Sir, in that case, geometric mean will be a better option because that number will tell us that what return what specific return it is giving it down the years. So it will help us know that what to expect in next few years.
Very well pointed out, Dhruv, and of course, all of you have participated with it. Arithmetic mean is just a plain average. That's it. It's a vanilla average. I mean, you just take the average of every returns of every year and divide by number of years, number of observations. That's it. But I would say arithmetic mean is bias. Arithmetic mean is biased towards positive numbers, and I'll just prove that to you, right? I think I have the image with me. Yes, uh, let's say I have invested 100 rupees today, or let's say the share price is 100 rupees today. After 1 year, the share price is 200. Right? What is the return percentage? 100%? Can I say, beta? Can I say 100% return? I'm ignoring dividend. So the share price from 100 to 200. So can I say 100% return? Right? So 100% return for the first year, and for the second, can I say from 200 it is 100 now? So can I say it is minus 50? Can I say it is minus 50? Let us calculate the arithmetic mean. You can see the calculation at the end. 100 minus 50 by 2 is 25% return. Now look at this diagram. It was 100 to 200 to 100. In fact, your return is 0. If you started with 100 rupees, and if you end up with 100 rupees again, your mean is 0 in fact. So arithmetic mean is biased towards positive numbers, right? So let us do that using the geometric mean formula. Geometric mean formula is nth root, and in that root you have 1 plus r1, that is, let's say, return for the first year 100%, and this return into 1 plus r2, that is the return for the second period, right? Minus 1, because you want to get rid of the principal amount. That's why you do minus 1, and minus 1 is outside. So if you do this, 1 plus r1, 1 plus 100% is 1. So 2 into 1 minus 50% is so 0.5. So 2 into 0.5. I'm just doing the math. You can do better than me. 2 into 0.5 is 1. 1 minus 1 is outside, 0. So you got 0. So geometric mean is giving you the right answer. So as Dhruv has pointed out, if you just want to know the average, you do the average arithmetic mean. But if you want to know the average compounding rate per period, understand, average compounding rate per period. So over 2 years period, what is the on an average compounding rate? 0%, because you got to 0 now. So I think geometric mean makes more sense, right? uh, arithmetic mean, arithmetic average or mean is overly optimistic for long term, and geometric mean is overly pessimistic for short horizon, right? You know the answer. We just discussed. I'm not dragging this so much. Some calculations are there in case someone wants to know the formula. They can write down the formula. In this case, 4 years are given. Fourth root 1 plus r1, 1 plus r2, 1 plus r3, 1 plus into 1 plus r4, and then minus 1, fourth root, and outside minus 1. So 10% minus 5%, you do apply the geometric mean, the answer is 9.58%. So I can say, if I start with 1 rupee, after 4 years, I will have 1.4421. That means I have 44.21% return above 1 rupee. I hope I'm not going too fast, right? So what is the average every year return? Because geometric mean is annualized 9.58%. I'm making on an average 9.58%. ठीक है beta, shall I not, I should not put too much emphasis on this because you know this, right? So if you do arithmetic mean, you got 10%, but that is not right, because if you calculate that manually, see, I have calculated this manually, I get 44.21. So geometric mean is the right answer for if you're holding the investment for more than one period, right? Okay, I'm going towards risk, huh? $1. If you have invested $1 in 1899, in 2017, in the equities market, you should have 47,661. In the bonds market, you should have $293. In the bills, that is government bills, T-bills and everything, $74. Why there is a change, this much change? And there is also a change if I do the inflation adjusted. So this is inflation adjusted without inflation. So $1 will give you 1654, 10.2 in case of the bonds, and in case of bills, 2.6. Yes. Why there is a variation here, guys? Can someone tell me why there is change, difference is so large, please? Very simple question, but please. Why, please? May I ask someone? May I ask Ankita Majumdar, please, beta? Why, in case of equity, this much value you have after certain years, and in case of bonds, and in case of हमारा time हो गया क्या class का? Because someone from other next class has come. No, we have time. Yes, Ankita, can you tell me, beta, please? Faster, beta, please. Why equity market is giving you more? Very simple question, beta. Please give it a try, beta.
Like share markets, so like return is more.
The return is more, but why? What is also more when you invest in equity market? Let me kind of give you an answer to this.
It's a risk and risk also.
Risk and return always go hand in hand, right? Right. Sometimes husband and wife don't go along, but risk and return generally in the ideal world always go along, right? In the ideal world, I'm saying, right? So, how do you measure risk? Again, actual information. You can see the rate of return for last certain years. Let's say 1998 to 2007, 10 years. You can see the rate of return. I have calculated. I mean, it is calculated. I have taken this from the textbook, right? For this period at least. 21.84, 36.99, etc., etc. What do you observe in this, Ankita? Please, if you could help me, beta, Ankita.
Yes.
What do you observe in this data? Yes.
So the equity is like rising.
No, equity, this is rate of return. So it is a combination of capital gain plus dividend, and the rate of return is calculated for every period. So if I'm investing in 1998 beginning price, ending price difference, capital gain plus dividend of 1998. So the performance is 21.84 and so on. For all this 10 years, the performance is given to you. What do you observe in this? That is my question, beta. Okay, think about it, beta. Let me ask someone else. Harsh Dani, please, beta, if you could tell me, beta, what is happening here? Harsh is there? Or will it take time? Harsh Dani, please.
Sir, in second, they are showing that how inflation has affected the dividend, and first only.
No, this is because of the capital gain. Understand? So this, so what do you see, beta? Here, let me ask someone else. I want the some participation. Then I want to say, beta. Let me ask. Maybe Harsdan is not responding, so I should make a note of this. Parin Shah, please. Parin Shah, please. Parin Shah, please. Yes, please. Okay, so guys, yes, beta, Ankita ji, please बताइए what you were saying.
That previous like the difference was that the inflation, how inflation also sometimes affect the dividend return. That was
Okay,
the
okay.
same.
Not only inflation beta, this is just capital gain. So company share price is fluctuating maybe. Company's share price is moving up and down. That could be the reason for capital gain. Or company may have may have distributed dividend. I don't know why other section students are joining early. I have to expel them. Yes. So you what I see here is that there is a lot of fluctuation beta. Do you agree with this, Ankita, Anjali, Mayur? Do you agree with this? There is a lot of fluctuation in this with this company, actual company. We all know, right? So you see a lot of fluctuation here, right? So and how do you measure fluctuation? Tell me. You have to unmute yourself, beta.
So we can from the difference from the previous year.
Okay. So, but how do you measure this fluctuation? I mean, for this 10 periods only, beta. Anyone, please? Let me ask Anjali. Good response.
No,
Let me ask Deolina Bajaj. Yes, Deolina beta.
सर इसमें वो कॉन्सेप्ट आएगा क्या मीन एंड स्टैंडर्ड डेविएशन वाला?
Yes,
It just came to me.
So the fluctuations and the deviation variability is measured by what? It is measured by standard deviation, or you can say variance. So in the next session, you know this, so I should not spend so much time on variance and standard deviation because that's statistics. But how that is important in finance, that is where we will focus upon, and we will not be spending so much time on going to the CAPM model. In fact, there is a theory and everything follows, but we cannot go because this is an advanced course. But I will touch upon the formulas and everything that you should know, right? So in the next session, we will discuss how to measure risk, how to calculate expected risk. So I have shared what is to be read. So I will try to share this PPT upfront maybe, and I will also share I'm not sharing the PPT upfront, understand, because you, as you mentioned, I'm always changing PPTs, you know that now, because I'm always updating. See, I'm always, whenever I get some new idea or something, I always change it, right? To make it better for you guys. So that's why I want to, but I will share the PPT or something through mail. So shall we end the session? It's time, I think. Right? 11:10 is the time, I think. Yeah, right? Shall we end the session, guys? Please tell me something.
Yes, sir.
Guys, I want participation. Please inform everyone in the class that they should participate. They should answer my questions. If they are not, otherwise I'll not be able to give them the attendance, and they'll be missing out a lot of things because this course is not easy. You know that now, right? So please ask them to join and ask them to be there, alert and answering that. Right? Please. Thank you so much. I'm ending the session because I have next session right after this. Yes. Thank you. Bye. Have a good day. We will meet Saturday.
Thank you, sir.
We will meet Saturday, huh? We will meet Saturday. Saturday. Yes. Yes. Thank you.
Thank you, sir.
Thank you, beta. I'm ending the session. Thank you, beta. Yes.